Good morning, everyone. Another day to do business. Welcome to 55 minutes of current and relevant business conversations right here on Business Morning. I'm Ini Jodmekwa, and we start as usual with what's going on in the global oil space, where prices fell as an expected build-up on U.S. crude inventories outweighed a temporary halt in output at two large fields at Kazakhstan, and geopolitical pressure from the United States threats of tariffs over its bid to gain control of Greenland. Those have weighed on prices this morning. So we see a deep fall for Brent, 1.37%. The price is at $64.03 a barrel. WTI is also down 1.19%. And the price settles at $59.64 a barrel. Both contracts closed nearly $1 a barrel, or 1.5% higher in the previous session, after OPEC Plus producer Kazakhstan halted output at the Tengiz and Korolev oil fields due to power distribution issues. Strong China economic data also, which showed positive, has an impact on that. And the U.S. President Donald Trump's promise to fresh tariffs on European nations, 8 of them, if no deal for the U.S. to gain control of Greenland was reached, is adding pressure to the oil market because the tariffs risk slows economic growth. President Trump had said that there was no going back on his goal to control Greenland. And to our market now, that's the Nigerian equities market. It closed slightly up at the close of trade yesterday. It's 0.09% for the all share at 166,276.82. We're still retaining the 106 trillion naira level that's for like 3 days now. We've had that 106 trillion naira. Volume yesterday, 795.45 million. Value, 19.97 billion, and deals in the red there at over 45,000. Top gainers, Deep Cap, NPF, Microfinance Bank, and there's the Nigerian Police Force Microfinance, and then there's Red Starex. They were the top trades. On the loser side, Alex, Jay's Bank, and FTN Coco also. And then on the flip side, as the top trades, we had Tantalizers, NSL Tech. For a second day running now, NSL Tech is one of the top trades, picking up the interest of a lot of investors as well as ZIGs at the end of the day yesterday. The Nigeria Employers Consultative Association, that's NECA, in collaboration with the Nigeria Social Insurance Trust Fund, they've flagged off the 2025 edition of the NECA NSITF Workplace Intervention Project, SWIP, with an interaction, enlightenment forum, and award ceremony. The event, which drew captains of industries, policymakers, and organized private sector leaders, had the Minister of Labor and Employment, as well as the Minister of State for Labor, in attendance as the participants renew calls for safer workplaces and improved compliance with employee compensation regulations.
We also have member companies of NECA.
Making the workplace safe is the pivotal factor for this gathering, as the NECA NSITF Workplace Intervention Project 2025, a critical platform aimed at deepening awareness on workplace safety, employees' compensation, and industrial harmony across Nigeria's labor ecosystem, takes center stage. Industry leaders, regulators, and employers engaged in robust conversations on creating safer work environments, reducing occupational hazards, and strengthening compliance with the employees' compensation scheme. First is the keynote speaker, the Minister of Labor and Employment, who emphasized that protecting workers remains central to productivity, economic growth, and sustainable industrial development.
I want to thank each and every member who has made presentations here, and to say that you have done very well and you are contributing greatly to the success of what we are doing as a government and to the success of what the National Assembly is going to do.
On her part, the Minister of State for Labor also emphasized the need for stronger collaboration between government, employers, and employees.
I wish to reaffirm that this administration will not compromise on occupational safety and health. We are strengthening enforcement of the Factory Act, and we'll be calling you very soon to come and partner with us and make sure that those laws are reviewed and is passed with speed of light.
For NECA, the Workplace Intervention Project represents more than advocacy, while the Nigeria Social Insurance Trust Fund (NSITF) reaffirms its commitment to prompt compensation, efficient service delivery, and continuous engagement with employers.
A 10th convention was added, which is the Occupational Health and Safety Convention, to reinforce the need of occupational health and safety in the workplace. So OSH is no more an option. It's no more a necessity. It has become a fundamental part of the issues in the workplace.
We will advocate and continue to advocate for workplace safety. We will work together with industry stakeholders to strengthen and continue to strengthen compliance, and we will celebrate excellence where we find it.
A major highlight of the event was the award ceremony. The NECA NSITF SWIP 2025 Forum reinforces a clear message. Safer workplaces are not optional, but essential.
That's right, we head to Davos now in Switzerland, where the federal government has assured global investors of the country's huge potential in the solid minerals sector. At a global business roundtable on resilient supply chains for the energy transition that was held at the Nigeria House in Davos, Switzerland, on the sideline of the 56th World Economic Forum, the Permanent Secretary of the Ministry of Solid Minerals Development, Mr. Farouk Yabo, told investors that the administration of President Bola Tinubu is providing an enabling environment for businesses to thrive.
The Nigeria House in Davos is packed full as the country engages investors attending the 56th World Economic Forum. The focus here is on opportunities for investment in the solid mineral sector.
The
Permanent Secretary of the Federal Ministry of Solid Minerals Development sets the tone for the conversation.
The administration's renewed hope agenda. Nigeria is currently undertaking huge structural reforms to diversify our economy, unlock growth, and build productive sectors that are meant to create jobs and long-term value. And of course, central to this is the transformation of the solid mineral sector.
The discussion moves into a panel session which focuses on resilient supply chains for the energy transition. The federal government says it has the natural resources that the world needs.
If you look at the sea's natural resources, which the global world economy cannot survive without today, we all have all these in Nigeria. When you talk about the first one being sand, salt, copper, iron ore, lithium, and the last one being oil. 5 of the 6 is solid minerals.
What we are doing is to create the enabling environment in Nigeria, talking about setting a global company that can engage with partners, also talking about organizing our artisanal miners. So what we have done in Nigeria is to set up a very clear strategy that will allow for global players to find comfort in investing in this particular space.
Also joining the conversation is the president of the Swiss-Uganda Chamber of Commerce. She says the chamber is also willing to do business with Nigeria.
We are really open to engaging with Nigeria House, engaging with other partners interested in doing business in Uganda. In Uganda itself, We also have several minerals available. We have about 10 gold refineries. We have cement, we have lithium, we have several minerals.
In the coming days, Nigeria will be engaging with more investors in various other sectors at the World Economic Forum. From Davos, Switzerland, Emperor Simon, Channels Television News.
Well, one of the main sessions still there at Davos, titled Africa's Job Engine, Nigeria's Minister of Foreign Affairs, Ambassador Yusuf Tugar, was a member or the panelist in one of those sessions, and the discussion centered on jobs creation, especially with Africa's surging youth and youthful population, and the rapid urbanization, which has also been recorded on the continent. Ambassador Yusuf highlighted some of the efforts that the Nigerian government has made towards job creation in Nigeria.
We have put in place regulatory frameworks, legal frameworks. There are laws in place, Electricity Act, for instance, that allows for you. So it's uncoupled distribution, transmission, power generation, and created opportunities for businesses, for private sector to come into any of the subsectors and set up and take advantage of that, I should say, decoupling. Feed-in tariffs, but of course there's a gap because you need to also sensitize private sector. They need to understand the opportunities that exist therein, and this is something that we also face in our regional economic community. So many legal and regulatory frameworks have been created, but private sector is sometimes not even aware of the opportunities. ECOWAS trade liberalization scheme that you register your products and you're able to move them freely without paying taxes within the region. So all of that is going on. Where we see huge potential for job creation is, for instance, in business process outsourcing, ITO, GBS, because it would create. We're in a race against time. We are adding 3 million young people to our job market every year. 1 million graduates, 40,000 engineers. So then at the same time, within Nigeria, we've created the National Credit Guarantee Company because we see the advantage of and the multiplier effect of credit guarantees. We have also put in place a National Consumer Credit Agency, so it allows for credit history and all of that. So it's a nation of entrepreneurs, and putting all of these frameworks in place unleashes, the potential that has always existed. But then when you go down to the rural areas, to the villages, you also see a lot of things that are happening just by providing that enabling environment.
And so from Davos there, the World Economic Forum, and President Trump expected to make an appearance today and give a full speech. Yesterday, the Canadian Prime Minister, Mark Carney, was there, and I guess he couldn't help but talk about the risk of global integration following what has been happening, especially from the United States. It also spoke on the importance and the need to deepen engagement with Africa, where partnership can drive growth, innovation, and shared prosperity amidst the global realignment with allies.
We are in the midst of a rupture, not a transition. Over the past 2 decades, a series of crises in finance, health, energy, and geopolitics have laid bare the risks of extreme global integration. But more recently, great powers have begun using economic integration as weapons. Tariffs as leverage, financial infrastructure as coercion, supply chains as vulnerabilities to be exploited. You cannot live within the lie of mutual benefit through integration when integration becomes the source of your subordination. The multilateral institutions on which the middle powers have relied, the WTO, the UN, the COP, the architecture, the very architecture of collective problem solving are under threat. And as a result, many countries are drawing the same conclusions, that they must develop greater strategic autonomy in energy, food, critical minerals, in finance and supply chains. And this impulse is understandable. A country that can't feed itself, fuel itself, or defend itself has few options. When the rules no longer protect you, you must protect yourself. But let's be clear-eyed about where this leads. A world of fortresses will be poorer, more fragile, and less sustainable. And there's another truth. If great powers abandon even the pretense of rules and values for the unhindered pursuit of their power and interests, the gains from transactionalism will become harder to replicate.
At the World Economic Forum, it's going to be a very interesting one today with President Trump expected to be there. Also in the Nigerian House, we're expecting a session that will have the World Trade Organization, Dr. Ngozi Okonjo-Iweala, and the MD of the Bank of Industry. So we're going to have a package coming from Davos today at the close of trade. And of course, you trust us right here on Business and Channels Television generally to ensure that you are well informed and up to date with what's going on there. But now let's look inwards on the continent and see our observations, or AFDB's observations more like it, on how 2025 was and expectations, the projection that the bank has for 2026. And we have joining us for this Professor Kevin Urama. He is the Chief Economist and Vice President for Economic Governance and Knowledge Management at the African Development Bank Group, AFDB. Prof, a Happy New Year. This is the first time I'm talking to you this year, I believe. Good to have you on the show.
Happy New Year, my sister. It's good to speak with you today.
Great. So I'll start with some of your key observations that you have shared generally on the economy, the African economy in 2025. So we see that, especially at one of the meetings, and I think I was in this meeting also. I had like 2 or 3 of your meetings last year where you said that Africa could mobilize an additional $1.43 trillion in domestic resources through tax efficiency. But you also highlighted the issue of illicit flows and digitization. You said that resource leakages has led to the loss of about $587 billion annually to corruption, illicit financial flows. That's illicit financial flows took a chunk of $90 billion. Profit shifting by multinationals, that swallowed up $275 billion. And you said human capital could add $47 billion to GDP if workforce participation improves. And you also highlighted the importance of AfCFTA, which could boost continental income by $450 billion by 2035. If you could help us expatiate on this and perhaps other observations that you saw in the African economy last year.
Thank you very much. First, as you've said, we are in an era where Africa is showing a lot of significant resilience in its growth and growth pathways. And also we're seeing a lot of transformative reforms that's going on across several African countries. And if I would say, Africa is actually surprising the world with regard to how economic development is happening on the continent since the post-COVID pandemic era. For 2025, we see that Africa's growth is expected to reach 4.2%. That's about 0.7 percentage point growth in 1 year alone. And in 2026, this might reach up to 4.5%. And this growth is very broad-based, with 32 African countries actually recording growth increases, and up to 22 African countries growing by more than 5 percentage points in terms of GDP growth. My sister, you will be elated to hear that Africa will host 12 of the 20 fastest growing economies in the world by the year at the end of 2025. Basically, Africa in 2025, 12 of the 20 fastest growing economies in the world were in this dear continent, Africa. And this growth rate that we're seeing means that Africa by 2026 could surpass Asia as the fastest growing region of the world. And this is happening because of a lot of reforms to curb illicit financial flows, to drive domestic revenue mobilization, to boost investments in industrialization and trade in Africa, and several other reforms that we have seen happening across the continent. So this growth pattern also leads to what we have seen in terms of increments in GDP per capita growth doubling since the year 2022. And all these things are very positive growth patterns that we see on the continent. Now, with regards to the curbing illicit financial flows and the domestic revenue mobilization, we have seen a lot of reforms across several African countries to boost domestic revenue mobilization. As you were giving us the feedback from Davos and the need for countries to look inwards, and you can see that Africa is already doing that in several areas. And tax to GDP ratios in Africa has begun to increase, including in Nigeria, due to a lot of the reforms that we have seen that is happening across the continent. So overall, the growth outlook for the continent in 2025, 2026, and 2027 are really, really very positive. And up to 6 African countries are already surpassing the threshold that we had estimated in 2024 in our key actions for inclusive growth for Africa, that is exceeding 7% growth in Africa for in the year 2023. We have countries like Rwanda, we have Ethiopia, we have Senegal, we have Niger, Guinea, and also Benin, that's already surpassing this threshold, which we have estimated will help to boost growth, improve job creation, reduce poverty on the continent. So all these things are very positive in terms of what's going on. And more interestingly, that growth pattern is broad-based across African regions. And we're seeing Eastern Africa continue to be the trailblazer, having growth projections of around 6%, specifically 5.6% in 2025 and up to 6.1% in 2026. And different regions, since we're in West Africa, the Western Africa region is also growing faster than expected, with 4.8% growth estimated in 2025. And this is because of great reforms that we have seen in different African countries, large economies of that region, including Nigeria. And Nigeria is expected to have grown by about 3.89% in 2025. And all of these growth outcomes we are seeing are due to a lot of the reforms and inward-looking policies that African countries has implemented since our release of that report you were citing, which was on making Africa's capital work for Africa's development. As you already mentioned, we have seen a lot we see a lot of leakages on the continent, as you mentioned in the summaries that you gave, due to weak economic reforms and economic policies that we had before, but not anymore. We're now beginning to see a lot of improvements in many of the African countries in those regards. And the knock-on effect of this is that many macroeconomic fundamentals on the continent are improving. Inflation is reducing on the continent, now expected to reach below the double digit by 2026. And also currency in Africa is stabilizing against the dollar, with 35 African countries gaining appreciations in their currency against the dollar in 2025. And also, when you look at debt dynamics, the same is happening. Our debt to GDP ratio is improving in Africa. And across sectors, we see that even though the debt service and debt refinancing risk remain to be high on the continent, the stock of debt on the continent is going down, estimated to now go to about 62% of GDP. And trade frictions have continued to increase, but also very interestingly, in Africa, the impacts of the tariffs has been very minimal, with Africa recording trade balances in several countries. So, I would say that our expectations in Africa is a positive, resilient growth in the medium to the long term.
All right, Prof. You did a summary of everything there, but we would like to touch on some of those things. First of all, as a Nigerian, I guess you should expect that I will ask this. I didn't see Nigeria among the top performing countries, and I'm saying, what's going on? Have we already surpassed that level or what?
Now, Nigeria, you have to always think about the starting point. Nigerian government has implemented a lot of transformative reforms in the past few years, and that has continued to improve the growth performance of the country in all aspects. Like, if you look at the Nigerian economy, as I've mentioned, the estimated growth for 2025 is 3.89%. This is a marginal increase from what we had in 2024. And normally what we look at in these our estimates and reports is the direction of travel. Because when you are talking about percentage growth increases, large economies, the percentage growth increases might look smaller, but in real terms, they are actually growing the economies much better. If you look at a percentage is just a ratio of what you had before. So that's the issue with Nigeria. So Nigeria is really on a very positive trajectory with all the reforms that are going on in the country. Now, I've seen strengthening fiscal and monetary policy coordination in Africa that is also creating stability in the Naira and several other indicators on the continent. Like I've said, the positive growth trajectory is very broad-based, across the countries by regions and also by economic groupings. And Nigeria is not left behind in this. That's very positive signals that we're seeing. But to continue to sustain the reforms and implement the reforms, and also continued engagement with the citizenry to ensure that people understand the need for these reforms that are ongoing, continues to remain important in Nigeria. Also, for debt, Nigeria has improved in terms of its debt to GDP ratio, but debt to revenue ratio in Nigeria still remains high, but the direction of travel is still very positive. So fiscal performance has also improved in Nigeria on the revenue side, with up to 22% higher revenue generated in 2025 compared to 2024. So again, if we look at Nigeria as a very large economy in the continent, the direction of travel is very positive. And like I've said, the growth rates that we're seeing, the increment in growth rates in Western Africa region, is actually credited to the growth rates that we have seen, improvements in growth rates we have seen in the large economies in that region, including Nigeria.
So do we have a projection for the GDP for Nigeria for 2026?
Yes, Nigeria in 2026 is expected to continue to improve in its GDP growth. There are several factors that we are watching, which will define the define the exact projection that we have, but it's on a very positive trajectory.
All right, Prof. I mean, looking at Africa now, the issue of illicit flows, I know that the Afdb has really, you've had a lot of sessions and meetings on this. I wonder if you could give us latest numbers, any improvements to the efforts of governments on the continent to block these leakages that's costing us hundreds of billions of dollars, if not more.
Again, staying in Nigeria, you see a lot of reforms, including the new tax bills in the country, the digitization of tax administration, the simplification of the tax administration, and different reforms that are going on. All these all derive from the impacts of digitization that we have continued to emphasize is central to curbing illicit financial flows. The new estimates for illicit financial flows for 2025 is yet to be finalized, but you will expect that with digitization of taxation and better improvements in compliance in tax administration, and also better digitization across different sectors in the countries, in Africa, we're expecting that all those will continue to start having implications for reducing the outflows that we have on the continent. And the impacts you see on real GDP growth and GDP per capita growth are all evidence that we can also derive from to show emphasis on reforms and transparency and accountability are all going to pay dividends in the medium to the long term. And as you may remember, my dear sister, we also launched this report on Public Service Delivery Index for Africa, and we are currently engaging to do surveys to be able to understand, especially not just the financial numbers, but the implications of these reforms on the lives of people on the ground and how people perceive public service delivery that is happening across the continent. So maybe during our annual meetings, when the African Economic Outlook report for 2026 will be released, we'll be better prepared to provide the numbers you are asking for.
All right, Prof. Thank you. And I'll certainly be looking forward to that, because I know that you also have your eyes on the public service. One of the meetings you had last year was on that. And I know that more countries are participating in that. I would also like to talk about the management of debt. I know you said it's optimistic. Maybe generally now, if you can give us an outlook, do you have numbers yet of what we can expect looking at the use of capital, more trade going on the continent, especially intra-African trade, and how this could affect debt for 2026?
Thank you very much. Like I was already said, Africa's debt dynamics is improving significantly, but challenges remain. Within measuring the debt to GDP ratios on the continent, we have seen a steady decline in the debt to GDP ratio since the post-pandemic era. It has declined from 66.3% in 2023 to now 62% between 2025 and 2026. That's what we estimate in terms of the direction. And this decline is signaling improving debt sustainability across the continent and more predictable macro environment, which again will attract better investments. As you can see, FDI inflows on the continent in 2025 have also increased. And all these, coupled with domestic revenue mobilization, will all improve the debt dynamics on the continent. Remember, debt sustainability measures are always looking at ratios, debt to GDP ratio, debt to revenue ratio, debt to this ratio, and so on. So the more we improve, refocus not only on the quantum of debt, but also on the other side of the equation with regard to domestic revenue mobilization, we will continue to see improvements in our debt dynamics on the continent. But the challenges that remain are more driven by global economic fundamentals, because the rating agencies and the risk profiles of the countries, as currently being estimated, continue to hike the cost of debt on the continent, and debt refinancing on the continent remain high because of the stock of debt that were borrowed in previous years. Because of all these factors, we're seeing two major risks in the debt dynamics on the continent. And one is the debt refinancing risks, which is estimated to cost the continent on average about $10 billion every year up to 2031. And this is not because of new borrowings. This is because of the stock of debt that's already borrowed during the low interest rate era to invest in infrastructure and other things. And this This is why the African Development Bank worked with the African Union Commission to develop the Africa Financing Stability Mechanism to help in this debt refinancing that is becoming a challenge and will remain a challenge for some time in the continent. And the other challenge there is the switch from lower cost, longer term development financing to higher cost, shorter term commercial loans that African countries have to face because of the change in the structure of debt currently. And again, a number of initiatives by the African Development Bank, including local currency financing and other things that is going on, are being designed in order to help to improve that. Now, the dominance of the dollar with regard to the currency within which Africa borrows and pays its debt remains another problem, which we need to continue to look into how to address, including creating hedging solutions, like I've said, local currency investment instruments, and so on and so forth. So, and finally, as you may we may remember, the African Development Bank in 2022 worked with the IMF and the World Bank and other agencies to set up the Africa Public Finance Management Academy, within which we have been training several African debt managers and finance officers to be able to better negotiate and also better manage the debt structures, the debt in their countries. So again, we are seeing positive trajectory in this area, and I'm hoping that we're going to continue to see positive trajectories as we continue to implement capacity building, institutional reforms, but also more importantly, accelerate domestic revenue mobilization in the continent so that we're able to repay our debts without having to recourse to more debt in order to repay debt.
All right, that's an interesting one. Pay off our debts without recurring to more debts. But Professor, please just give us a minute. We need to take a commercial break or a break. When we come back, we'll continue with the conversation. We still have issues as the drivers of that growth, which AFDB is very positive on. We will look at that. And the big one, infrastructure funding. That's a major one. Insufficient or underdeveloped infrastructure on the continent, both for intra-country trades and even inter-country trades. Those are some of the hurdles which Africa has to overcome to hit some of those numbers that's being projected. But that's after the break. Please stay with us. You're welcome back. You're still watching Business Morning right here on Channels Television, and we've been speaking with the Chief Economist of the African Development Bank Group, Professor Kevin Urama, telling us the outlook of AFDB for the year, for the continent, for 2026. Prof, thank you for staying on.
Thank you very much.
So, Prof, at the foundation of all of these plans and outlook and development is infrastructure. Now, Africa's infrastructure development says that they need about between 130 to 170 billion annually if we are to close that gap. I wonder what the AFDB sees about this issue of infrastructural gap.
Thank you very much. Those estimates with regard to infrastructure financing gap, we have estimates for the different sectors for Africa's infrastructure on what is needed in order to be able to build resilient infrastructure to address the development needs of the continent. And then, but this is also at the backdrop of the estimates we've made with regard to the sources of financing that is available to Africa domestically that we can be able to mobilize. If you look at our African Economic Outlook report in 2025, which you cited at the beginning, we have the opportunities of mobilizing up to $1.43 trillion to be able to finance our own development. If you compare the numbers, you will see that there's huge opportunities for Africa by just improving efficiency in tax administration and tax collection, reducing illicit financial flows, and also addressing the risk ratings, risk pricing on the continent, and all those issues, and addressing corruption, to be able to retain enough resources to be able to invest in this, to fill this infrastructure investment gap. In fact, if Africa plays its cards well with regard to proper macroeconomic management, which we are seeing a lot of improvements in. If we continue to maintain the trajectory over time, Africa will be able to finance that infrastructure financing gap. But again, under the leadership of President CDO Tar, the new president of the African Development Bank, there has been a number of initiatives that is helping to make Africa actually mobilize that domestic resources that we have talked about and be able to retain that 1.43 trillion to finance its gap. He calls it the 4 cardinal points. The first one is clear, innovative ways of mobilizing and leveraging resources from Africa and Africa financing institutions and also global partners to be able to address that financing gap. You'll hear a lot more about this during our annual meetings. But one that I want to talk about is the new infrastructure that he is building with regard to what he calls NAFA, the new African financing architecture, where African institutions collaborate more, where have national development banks, regional development banks, African Development Bank, and others coming together under the principles of subsidiarity to be able to pool resources better and better identify and co-finance large infrastructure development projects across the continent. And it's just to say that there's quite a number of innovative ways of being able to fill that infrastructure financing gap that you mentioned, and a lot more will be discussed during our annual meetings in May in that regard. But again, the positive trend here is that Africa has identified that gap and is taking strategic effort to be able to address those gaps across different sectors on the continent. And there's a lot of positive outlook in that regard as well, because identifying a problem is one thing, but innovating to find solutions for that problem is another. And African Development Bank, under the leadership of President Tar, is actually leading the pack, working together with all the African financing institutions to find solutions to this.
All right, Prof. I mean, it seems like your AGM is already packed. We expect a whole lot because you keep referring us to your meeting in May, and well, we hope that we would be there. But as we come to a conclusion now, let's look at the drivers for this positive outlook that you have for 2026. We see things like strong consumption, and there you said there's expectation of wage increases in Egypt, South Africa, and Ghana. A global shift, a weaker dollar. We've seen that even this week. I think the dollar hit a 2-week low this week. And then, of course, the debt management, which you've already talked about. And then the intra-regional trade, which we saw started in 2025. Intra-African trade really increased. What trend do you see for all of this to push on? For instance, in Nigeria, it's a pre-election year. Do you expect disruption or distraction? We know that, I mean, a lot of things are happening globally now and sometimes seeping into the continent. What distractions or disruptions could stop these key drivers from actually birthing the positive outlook that the AFDB has for 2026?
Yeah, thank you very much. When I say this growth is broad-based and also the resilience that we have seen in the African continent since the post-pandemic year. That's one of the things, the issue resilience is that Africa has continued to surprise the world with regard to expectations of growth and the impacts of global tensions, global policy changes, but also national and regional changes that we've seen in these past years. These have not been able to actually stop the trend with regard to GDP growth, GDP per capita growth, and the improvements that we've seen on the continent. Take, for example, the trade tariffs you mentioned when you were relaying to us what was going on in Davos. There were expectations that this will have significant implications for growth on the continent, but this has not happened that much. So I have reasons to be very optimistic that African economic reforms has become robust enough to be able to withstand shocks. And that is why we keep talking about the resilience of the African economies. Now, but that doesn't mean there are no risks. The risks that I've mentioned before include the fact that the high cost of capital and debt refinancing risks could be a game changer for the continent if African countries do not increase the domestic revenue mobilization and put in institutional systems that will help African countries to refinance its debts. So that high cost of capital and debt refinancing risks remain a major macroeconomic risk that we need to look at significantly. Now, the trade tensions and frictions that we see in the global trade and the disruptions in global supply chains, all of these pose challenges, but they also come with opportunities for what you have referred to deepening regional integration, regional economic integration on the continent, trying to focus a lot more on Africa's own sovereignty, improving Africa's agency in trade, in commerce, and in all the things that we do. And those opportunities have been recognized before the challenges through the AFCFTA that's endorsed by the African Union. Again, it's more of implementing and continuing that trajectory, staying the course of those policy changes that have already been enacted in Africa will help Africa to address that risk. But another one, which relates to what you talked about in Davos, I'm very pleased to see the Nigerian government in Davos on talking about the natural resources and how to harness those resources and leverage the global transitions on green transitions to ensure that our natural resources play a key role in driving those transitions, but also a key role in creating domestic revenue and royalties for for the Nigerian government, and also the same for the African continent. My sister, when you look at the key minerals that will drive the global transitions, the nickels, the cobalt, the lithium, and the rest of that, most of African countries have rich deposits on these. Now, but the challenge is, how do we relate with these resources? Are we going to be issuing minerals development, mining development concessions, or minerals development agreements? So these are two different things, because the mining concessions we continue to give makes Africa trade at a very low value chain in the whole minerals value chain. And trading at that low value chain, you get low revenue coming from your natural resources. So African countries need to continue now to look at how to improve the minerals development within Africa through a number of policies we have already recommended during our AEO 2024 and 2025, including franchising and local content policy that a number of African countries are already engaging with and trying to drive, including Nigeria. So commodity dependence needs to end in terms of depending on trading low value add and low technology input commodities in order to get short-term revenue, but also selling out jobs and selling out value addition and the rest of things. So that is very important for us to focus on. But climate shocks remains a major challenge, and it continues to increase because the physical impacts of climate change has continued to now become a fiscal risk for many African countries and also globally. So we need to continue to watch all these risks and turn those risks to opportunities for innovation and opportunities for growth on the continent. And I'm very pleased also to say that based on the work we're doing across the continent, a number of African countries are doing just the right things in interacting with these risks and finding opportunities to use them as levers for growth.
All right, Prof, thank you so much. And it's all to make Africa's resources work for Africans. And we appreciate the work of AFDB. Of course, we would always ask for more. So at the end of 2026, we'll ask how much of this have we been able to make work for Africans. Thank you so much for your time, Chief Economist and Vice President for Economic Governance and Knowledge Management at the African Development Bank Group, Professor Kevin Rama.
Thank you very much for having me.
All right. We go global now with Will Ebon. Will?
That's an interesting conversation you were having with Professor Kevin Orama. But let's just jump in and see what else is happening in the global scene. We see U.S. President Donald Trump is due in Davos today, where he will take center stage at the World Economic Forum with a special address scheduled for early afternoon. Now, while the speech was initially expected to focus on domestic issues such as affordability and housing costs, it is now likely to take a stronger international tone following renewed tensions with European leaders. Trump has recently reiterated his interest in Greenland, citing U.S. national security concerns, and has threatened tariffs against countries opposing the move, adding a sharp geopolitical edge to his Davos appearance. Now to the UK. Now, inflation rose to 3.4% in December, its first increase in 5 months. According to official data, the figure is up from 3.2% in November and slightly above economists' expectations. And the rise is likely to see the Bank of England keep interest rates unchanged at 3.75% when it meets in February. Most economists, however, still expect a rate cut later in the year if price pressures continue to ease. Now, despite the uptick, inflation is projected to fall in 2026. With the Bank of England expecting to move closer to its 2% target by mid-year, helped by easing wage growth and government cost of living measures. Now, see what the European Union is up to. It's saying it's close to sealing a historic trade agreement with India as both sides move to deepen economic ties amid rising global trade tensions. European Commission President Ursula von der Leyen, speaking at the World Economic Forum in Davos, described the proposed pact as potentially the mother of all deals. The agreement is seen as a strategic response to a tariff threat from U.S. President Donald Trump, with a formal announcement expected during von der Leyen's visit to India next week. Now, let's see. Berlin-based climate tech company Clover has raised over $1.2 billion to grow solar and other green home energy solutions across Europe amid declining residential installations. And the startup provides software that helps installers manage rooftop solar, home batteries, heat pumps, and other clean energy systems while supporting customer financing and energy optimization. Now, Clover plans to use the funds to enter new markets, including France and Italy, and add services such as product procurement support for installers. Now, see, China has slammed the new Taiwan-U.S. trade agreement, saying it benefits Washington while weakening Taiwan's industries. Beijing called the deal a drain on the island's economy. The deal has Taiwan investing $250 billion in U.S. tech, while Washington lowers tariffs to 15% and increases tariff-free chip quotas. Now, Taiwan's semiconductor manufacturing company, the world's largest contract chip maker, plans $165 billion in U.S. chip plants. China says the move is a U.S. attempt to contain it, citing higher labor costs in U.S. facilities. Now, British luxury brand Burberry has reported stronger than expected sales over the key holiday period as consumers snapped up its tartan scarves, trench coats, and other core products, the company said on Wednesday. Now, comparable store sales rose 3% in the fiscal third quarter to December 27, beating analysts' forecast of about 2%. Now, let's head over to the U.S. market and see how they performed in trading on Tuesday, especially with the Greenland tensions.
The U.S. stock market took a major fall on Tuesday as the Dow Jones was down at 1.8%, the S&P 500 also down at 2%, and the heavy-tech Nasdaq took the major fall of the day at 2.4% down, as many investors are a bit concerned about the U.S. and the Trump administration's most recent tariffs, as this could have an impact on the global economy and the U.S.'s space in the global economy, as investors continue to watch how the U.S. economy responds to this, and if this will have a lasting impact on the U.S. stock market.
So much. That's our correspondent Maria Bird right there in the U.S. giving us fresh updates. Well, updates for yesterday. We'll look for fresh updates much later today on Business Incorporated. See you later.
Thank you so much, Will. And now, as we bring Business Morning to an end, we'll take you what's going on in early trade in Nigeria's equity market. It's a recovery. We see recovery from those two negative day close. Today, it's this early. It's 0.06% in the green and 166,359.8. It looks like it's going to be a bull day at the end of close or at the close of trade today. We look forward to that. That's all on Business Morning. Thank you so much for being a part of it. And later on today, I'll see you for Business Incorporated to give you updates from the world of business. I'm Ini John Mekwa. Talk to you later.